Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden within your favorite company's financial reports. And boy, do we have a juicy one today that seems to be trying to hide some serious financial turbulence behind big words and even bigger numbers. Aehr Test Systems, a company that makes equipment to test semiconductors, has just dropped their quarterly report, and let's just say it is a roller coaster with more dips than peaks. We are going to decode this report and see what is really going on behind the scenes at Aehr Test Systems. Before we dive in, if you love getting straightforward financial insights without the corporate jargon, make sure you hit that subscribe button. And hey, we have a lively community discussing these filings over on Discord, with the link in the description below. It is a great place to connect and share your thoughts. So, what is the big picture for Aehr Test Systems? In simple terms, they design and build equipment that is crucial for testing computer chips. Think of them as the quality control department for the tiny brains that power our world, from your smartphone to electric cars and even artificial intelligence. This report, a 10Q, is like a regular checkup for the company, telling us how they're doing financially over a 3-month period. And for Aehr Test Systems, this checkup shows some concerning signs. Let's peek at their balance sheet, which is basically a snapshot of what the company owns and owes. Their total assets are about $148 million. But check this out, their total liabilities, what they owe, are about $18 million. That might sound okay, but when you look at the equity, which is what is left over for the owners, it is around $130 million. The gap between assets and liabilities isn't the whole story. We see their accounts payable, what they owe to suppliers, jumped from about $6.7 million to $3.5 million between two reporting periods. This could mean they are paying off their debts quicker, which is good, but it also means less cash available for other things. Now, inventories are a big chunk of their assets, over $42 million. This means they have a lot of products ready to sell. But if those products don't sell quickly, it becomes a problem, tying up cash and potentially losing value over time. Moving on to the income statement, which tells us about their earnings and losses. This is where things get really interesting, or maybe concerning. For the 3 months ending November 2025, their revenue dropped to about $9.9 million. A pretty big drop of 27% from the $13.5 million they made last year during the same time. And looking at the longer 6-month picture, revenue fell from $26.6 million to about $20.9 million. That is a 22% decrease. This decline is mainly because they are selling fewer of those essential contactors, the parts that help test chips, likely due to a slowdown in the electric vehicle market, which uses a lot of these. This revenue drop directly impacts their gross profit, which is what is left after paying for the cost of making their products. It plummeted by over 50% in both the 3 and 6 month periods. Their gross margin, which is the percentage of profit they keep, also took a hit. It fell from a healthy 40% last year to just 25.7% this year for the 3-month period. That is a significant squeeze on their profitability. They explain this by saying they have lower overhead absorption, meaning their factories are not running as efficiently because there is less production. Plus, higher assembly, warranty, and freight costs are eating into their profits. When your profit margin shrinks that much, it means less money is available to cover all other expenses, like running the company. They are spending more on research and development, with an increase of 31% for the 3-month period and 26% for the 6-month period. This is often a good sign, showing they are investing in future products. However, with falling revenues and shrinking gross margins, this increased spending becomes a bigger burden. Their selling, general, and administrative expenses, which cover sales, marketing, and the overall management of the company, stayed pretty much the same. While this seems stable, when revenue drops, these costs become a larger percentage of their overall sales. So for every dollar they earn, they are spending more just to keep the business running. Now here is something interesting. Aehr Test Systems took some restructuring charges. This usually means they are making big changes, like closing down offices or letting people go to save money. They had a credit of $213,000 in the 3-month period, which sounds good, but it is actually because they terminated a lease early, which caused some costs, and then they got some money back. They also had workforce reduction. These actions indicate the company is trying to cut costs because it is facing financial pressure. Their interest income, the money they earn from their cash reserves, is going down. This is expected when interest rates change and when your cash balances decrease. But in the 6-month period, other income saw a big jump. This seems to be mainly due to a refund they received from something called the Employee Retention Credit, or ERC. They got about $1.3 million back for that. While that is a nice one-time boost, it doesn't mask the underlying revenue and margin problems. And when you put it all together, the bottom line is a net loss. For the 3 months ending November 2025, they lost $3.2 million. And for the 6-month period, the loss was even bigger at $5.3 million. This translates to a net loss per Aehr of 11 cents for the 3-month period and 18 cents for the 6-month period. This means for every share of stock, the company lost money during these periods. Let's look at how shareholder equity has changed. While they did issue more stock through a public offering, raising over $9 million, this also dilutes the ownership of existing shareholders. It shows they are trying to get more cash into the company. The company is also expensing a significant amount for stock-based compensation, over $3.5 million for the 6-month period. That is the cost of giving employees stock or stock options. While it is a standard practice, it reduces the reported profit. Note 10 on restructuring charges confirms their efforts to streamline operations. They are involved in consolidating facilities and optimizing their cost structure. This is a clear signal that the company is under pressure to improve its financial performance. Now, let's talk about the legal side. There was a class action lawsuit filed, alleging the company made misleading statements about its earnings. While the lawsuit was eventually dismissed voluntarily by the plaintiffs, and later by the court, it shows the company has faced scrutiny. More significantly, there is an ongoing intellectual property dispute in China involving patents for their wafer burn in systems. They are suing a company called Suzhou Semite Instruments, and the case is complex, with appeals ongoing. This type of legal battle can be costly and uncertain, adding another layer of risk. Their revenue recognition policies seem standard, where they record sales when control of goods or services is transferred. They break down revenue by geography and product type. Asia is still their biggest market, accounting for over 77% of revenue in the last quarter. However, this is a big drop from last year when it was 73%. The systems part of their business is growing, which is good, especially with AI-related applications. But this growth is being overshadowed by a sharp decline in their contactors business. The fact that their gross margin has dropped so dramatically from over 40% to the mid-20s is the most concerning part of this report. This tells us that either their costs are way up or they are being forced to sell their products at much lower prices. Either way, it's a sign of underlying weakness. Overall, Aehr Test Systems is in a tough spot. The semiconductor industry is cyclical, and they are clearly feeling the pinch from a slowdown in certain markets like electric vehicles, while they are investing in future growth areas like AI and focusing on cost. Cutting the significant drop in revenue and profitability is a major red flag. They did manage to raise some cash through a stock offering, but this comes at the cost of diluting existing shareholders. The ongoing legal issues in China also add a layer of uncertainty. My take is that Aehr Test Systems is navigating choppy waters. They appear to have some promising technologies, especially with the growth in AI. But the current financial performance, especially that shrinking gross margin, suggests they are struggling with profitability and demand in key areas. They need to see a significant rebound in their core markets or a strong acceleration in new ones to turn things around. The increased R&D spending is a positive for the long term, but in the short term, managing costs and increasing sales will be critical. Now, what is your take on these numbers and what they signal for Aehr Test Systems' future? Do you think they can weather this storm? Drop your thoughts in the comments below. If you found this breakdown helpful, please smash that like button and don't forget to subscribe for more in-depth corporate analysis. And again, check out the Discord community linked in the description. Thanks for watching, and we will see you next time on Corporate Decoder.